Hey everyone, in this video we're going to go over how to invest in stocks. Now, starting out can be tough. That's why I'm going to cover the fundamentals you need to get started so you know what to expect and the type of stocks you can buy. Okay, so as advertised, I'll be donating to charity for every like, comment and subscription up to $100 for this cycle. Likes and comments are 3 cents each and subscriptions are 4 cents each. Further details will be in the description below. Now let's get to the analysis. Firstly, you will need to choose a brokerage firm or set up an account with an online brokerage to be able to buy stocks. And the reasons you would normally go with a brokerage firm is that it's a lot simpler. Some firms may offer advice as a service, and it's normally better to only take advice that you pay for, as sometimes they might recommend a good stock where they get a better commission as opposed to a great stock for you. And if you go with an online broker, they're normally cheaper per trade, but it can be hard to get help with setting up your account or if you run into issues. Okay, now you have your account, you might think, okay, I want to buy a company's stock as it's been performing well and people are getting good returns over the last few months. I should get that too, right? And unfortunately with stocks that are in the news due to good growth, they will normally take a dip and normalize. This is not always the case, but I would not be buying stocks based on the fact that they had recent big growth without doing further research into the company's financial reports and its value. Now, there are two main types of stocks. Dividend, where the company pays you money for owning stocks on a periodic basis, and growth stocks, or stocks that reinvest their money back into the business to grow its earnings and in turn its stock price. Dividend stocks can be a great way to supplement an income or just to do better than inflation, are normally less risk, but don't confuse this with risk-free. And with dividend stocks, you might think I'll just look for the stock with the highest dividend and that's the best one, right? Not exactly. While rare, some companies will pay large dividends, but the stock price will go down year on year. And while the dividend percent is good, the value of your stock goes down and you could be much worse off than if you had picked a company with a bit lower dividend, but is growing its stock price as well. Now, for growth stocks, there are two main methods or variations of the methods that you can use to pick stocks. The two I will touch on here are charts and value investing. Stock charts are used to gauge what the price of the stock is compared to what it was up to a specified time frame. For example, the stock price changes over a day, week, month, year, and so on. You can also look at different markers like Bollinger Bands, RSI, and MACD, to name a few. Now, there are whole courses on this subject alone, and looking at charts over a longer time frame is normally better than looking at a shorter time frame. Now, for value investing, this is where you would look at details like the price to earnings ratio, the earnings per share, and the growth rate, to name a few. And you could use a formula to try and estimate what the stock is worth. There are many different formulas that you can use, but remember they're all estimates and the market can change based on how people feel about the company and not how the company is doing financially. And companies that are doing great financially normally will be able to weather the lower stock price and continue doing business. But a company that has great prospects and market backing can only be in debt for so long before they need to pay their debts back. And if they can't, they may go bankrupt even if their stock was at an all-time high price. Now, index funds can be great if you don't want to devote too much time to researching stocks and are happy to leave your money in the fund for the longer term. This could be a couple of years or more normally. Index funds are great because they have fractions of shares in many companies, so the risk in companies falling or their stocks dropping can be mitigated by all the other companies in the index fund. Not to say that they won't fluctuate in price or even drop from time to time, but normally because the risk is spread between around 200 to 500 companies for some of the main index funds, the risk is spread between all the different companies in many different industries. Now, timing the market versus time in the market. A lot of people say time in the market always beats timing the market. But there have been rare cases where even index funds that if you bought in at close to the all-time high that then tanked took 10 years to recover. I say this not to scare you, but to let you know what to expect. Now, for time in the market, this means that you buy early and just leave your money in stocks for a long period of time. This can be good if you pick some companies with good financials at a fair or discounted price and you want to forget about them for a few years or decades and won't need to take the money out in the shorter term. Or you could try and time the market by waiting for a stock to crash or even most of the market to crash. But history tells us this could take around 7 to 10 years. Not exactly, but this has been about the average. It could be longer or shorter time frame than this, and the average value of the market could have gone up and you might miss out on good returns if you had have just gone with the time in the market strategy. For investing mentality, I'll use the value investing principles as an example. I would start by seeing if the stock is cheap, then I also look at the company's financials to make sure they are not in a lot of debt, that their financials are healthy among other things, and the reason I do this is to be comfortable that the risk of the company going bankrupt is as low as possible. So if you see a 10, 20 or even 80% drop in the stock price, I would be more likely to buy more as opposed to sell at a loss, so that in a few years' time when it comes back I could make 15 or much higher returns. Hey everyone, if you want to keep up to date with my videos, remember to subscribe and set notifications to all. I say all this not to scare you, but to prepare you mentally for what stocks can do, so that when a crash happens, you know you have done your research and are okay when everyone is selling and the price is dropping because you did your research. You know that the likelihood of the company going bankrupt is low and that most will come back after a couple of months to a couple of years' time. Thanks for watching, and if you want me to make more videos about any of the topics covered here or any other financial topics, leave a comment below with what you would like to see and I'll do my best to make it happen. Thanks again for watching. Also, a quick legal disclaimer, I'm not a financial advisor and this should not be taken as financial advice. Please consider talking to a financial advisor before making investment decisions.